Welcome to TradeLog AI Academy. In this lesson, we're building a range trading playbook you can execute like a system. Upper band, lower band, fakeouts, stops, and targets. Ranges are where most traders overtrade, get chopped up, and lose discipline. Your edge comes from structure, patience, and rules. Let's turn ranges into something simple and repeatable. A tradable range is a market that repeatedly moves between well-defined support and resistance over time. The key word is defined. You can point to boundaries the market respects. That's very different from random chop, where price swings without clean, consistent reactions. Reliability increases as the boundaries get tested more. A range tested 4 or 5 times is typically more meaningful than one tested once or twice. So, before you trade, qualify the environment. Professional range traders don't use a single thin line. They use zones. You define bands by connecting the major reaction highs for resistance and reaction lows for support. A zone matters because candles have wicks. Price can briefly pierce a level and still respect it. Zones capture that reality and prevent you from labeling every tiny overshoot as a breakout. If you want fewer false signals, stop drawing perfect lines and start defining realistic areas. This is the foundational rule. Your highest probability trades happen at the edges of the range. The middle offers weak reward to risk and unpredictable chop, so we treat it as a no-trade zone. Your job is straightforward. Look to sell near the upper band and buy near the lower band, only with confirmation. If you find yourself doing something in the middle, you're trading boredom, not structure. A clean edge entry is built on rejection at the boundary. Typically, you'll see a candle probe beyond the band with a long wick, then fail to continue. Momentum dies. The confirmation is that price closes back inside the established range. That close is not optional. It's what turns possible rejection into confirmed rejection. Without that close inside, you don't have a range trade. You have a guess. A fakeout, also called a false breakout, happens when price breaches a band and then quickly reverses. It's often a trap because many traders place stops just outside the range, and that liquidity gets swept. The pattern has 3 essential parts. First, the breach. Second, the close back inside. Third, the start of the reversal move. If you can read those 3 steps, you stop being the liquidity and you start trading the opportunity. Here's the mindset shift. The fakeout isn't just something to fear. It can be a high-probability setup. The confirmation is non-negotiable. Wait for the candle to close back inside the range. Acting before the close is chasing and usually puts you on the wrong side of the move. Once confirmed, you enter in the direction of the reversal, meaning you trade back toward the range, targeting the other side. Before you enter, you must know exactly where your idea is wrong. This is your invalidation. Stop A is tighter. Place the stop just beyond the high or low of the fakeout wick. It improves reward to risk, but it's easier to get clipped by noise. Stop B is wider. Place the stop beyond the entire range zone or prior structural high-low. It survives volatility better, but it requires smaller position sizing to keep risk constant. A structure-based exit plan is mandatory. You should never enter a range trade without knowing where profits will be taken. Target 1 is the midline. Take partial profit there to reduce risk and lock something in. Target 2 is the opposite band. That's the primary final target in a normal range environment. This keeps your process consistent. You're not improvising exits. You're executing a plan. No range exists in a vacuum. Always check the higher time frame trend. A range inside a strong uptrend is often just consolidation before continuation. In that context, longs at the lower band typically have higher probability because they align with the dominant trend. Shorts at the upper band are possible, but they're often counter-trend and require cleaner confirmation and tighter risk control. Context tells you which side of the range is safer. Combine time frames for a complete edge. Use the higher time frame, daily or 4H, to define the most meaningful range zones. Then drop to lower time frames, 15 meters or 5 meters, to spot the rejection candle or fakeout pattern with precision. Higher time frame gives the map, lower time frame gives the trigger. That separation keeps you disciplined and prevents overtrading random movement. Common mistakes and how to fix them. Mistake 1. Trading the middle. Fix it by waiting for price to test the true outer zones, edges only. Mistake 2. Entering before the candle closes back inside the range. Fix. The close is your confirmation. Patience is your edge. Mistake 3. Ignoring higher time frame context. Fix. Always check whether you're trading with the larger trend and prefer the higher probability side. Here's the full system. 1. Identify a clear range with at least 2 touches on each side. 2. Define upper and lower boundaries as zones, not lines. 3. Wait for price to test an outer zone. 4. Watch for a fakeout, typically a wick that breaches the zone. 5. Confirm only when a candle closes back inside the range. 6. Execute in the direction of the opposite band. 7. Place stops beyond the fakeout wick for tighter risk, or beyond structure for wider protection. 8. Target the midline first, then the opposite band. Range trading is mean reversion at the edges, not action in the middle. Fakeout equals wick out plus close back in, then trade the reversal. Targets are simple. Midline first, opposite band next. Log the setup in TradeLog AI so you can track which rules you followed and which ones you violated, because that's how your execution becomes a system.